We've already touched on outside basis, but we're going to cover it in a little bit more detail now. The outside basis, remember, is the partner's basis in the partnership. It starts with the beginning basis, and the beginning basis, remember, is either a transferred basis or the amount of the services I contributed. It's adjusted up or down by the effect of liabilities and up or down by the effect of operations. So let's first start talking about liabilities. We start with the basis before the change in liabilities, then we increase the basis by the share of partnership liabilities. We decrease the basis by a decrease in the share of partnership liabilities. We increase the basis by the partnership liabilities assumed by the partner. And then we subtract the basis by the partner's liabilities assumed by the partnership. All right, so when we talk about this general allocation, sometimes it can vary based on the type of liabilities involved. So the goal is to allocate based on the risk of loss. And the risk of loss is determined by whether or not the liability is recourse or non-recourse. A recourse liability is our normal liability we think about. The borrower is liable until the debt is paid, even if the property is sold to pay off the loan and it doesn't cover the entire loan balance. Just think about a liability you have. If you own a home or a car and you have a loan on that. So say I own a car, but I have a loan. That loan is 99.9% of the time secured by the car. So if I don't pay the loan, they'll come repossess my car and they'll sell the car to cover the loan. But do you think that the sale of the car is going to cover the loan balance? For most consumers, it's not, because for most consumers, they've borrowed probably too much to pay for the car. They borrowed the whole cost of the car, perhaps, and the car depreciates as the car drives off the lot. So for most of these loans, the car does not satisfy the loan. The taxpayer, the consumer, still owes what's left on the balance of the loan. It doesn't just go away. That's a recourse liability. Recourse liabilities are going to be added to a partner's basis only to the extent that the partner has a risk of economic loss. So for a general partner, the whole entire amount of the recourse liability allocated to that partner is going to increase the partner's basis. But for a limited partner, it's not, because remember, a limited partner is limited only to their investment, and then if they agree to kick anything else in, but it's generally they're not going to suffer an economic loss. A non-recourse loan is different. In a non-recourse loan, the lender can sell the property used as security if the loan is not paid, but the partner is not liable for any further deficiency. So that's my car loan example where I found this lender that will only secure the car. I'll take a security interest in the car, and then if the sale of the car doesn't pay off the loan, they won't further hound me anymore, right? They won't take any more of my assets. Non-recourse debts are allocated to general and limited partners based on their profit ratio. And that doesn't make a lot of sense to us, and we'll talk about further limits because that doesn't make sense. We'll talk about at-risk limitations that are going to apply to non-recourse debts. Recourse liabilities are added to a partner's basis only to the extent that the partner has a risk of economic loss. Most, if not all, recourse liabilities are allocated to the general partners. Non-recourse debts are allocated to general and limited partners based on their profit ratio. If the partnership has more than one general partner, the economic risk of loss computation entails computing a hypothetical loss and allocating that loss to the general partners. The hypothetical loss computation assumes the partnership sells all its assets, including cash, for the amount of non-recourse liabilities. If the partnership does not have non-recourse liabilities, the assets are deemed sold for $0. The hypothetical loss then is subtracted from the partner's capital accounts to determine their risk of loss. And we're not going to do that in this class. It will be given to you. Okay, we also make adjustments to basis because of the result of operations. Section 705 mandates a basis increase for additional contributions in partnership taxable income, including separately stated items, and also for tax-exempt items of income of the partnership. We saw that in that example we did. Remember, we had tax-exempt interest income, and we increased the basis by the amount of that income, even though it wasn't part of our taxable income. Section 705 also requires a decrease for distributions from the partnership to the partner plus the partner's distributive share for the current and prior tax years of the following: losses, and then expenditures that are not deductible for tax purposes and then that are not capital expenditures. What these basis adjustments are doing is preventing double taxation, because we are taxed, right, on all the income of the partnership, whether or not it is distributed. And so if we don't make these adjustments, if we later sell our partnership interest, then that interest would be taxed again. But it's not, because we adjust the basis up or down, and then we use that adjusted basis to determine gain or loss when we sell or dispose of our partnership interests. A loss deduction is going to be limited to the partner's basis in the partnership, so we can't further take losses after that. And then any distributive share of loss that cannot be deducted because of the basis limit is noted in the partner's financial records. It's not reported on the partner's tax return, nor does it reduce the partner's basis. Those losses can be carried forward until the partner has a positive basis again from capital contributions, additional borrowings, or partnership earnings. So I can carry forward that loss and take it when my basis will allow. What's Kelly's basis for her partnership interest in each of the following independent situations? The partners share the economic risk of loss from the recourse liabilities according to their partnership interests. A. Kelly receives her 20% partnership interest for a contribution of property having a $14,000 basis and a $17,000 fair market value. The partnership assumes her $10,000 recourse liability but has no other debts. Okay, so we start with our general rule that we take a transferred basis, a carryover basis of the contributed asset, so that's $14,000. To that, I subtract the debt assumed by the other partners. So she had a $10,000 recourse liability that was assumed by the partnership. She has a 20% interest. So the other partners who have the 80% interest assumed that. So we subtract that 80% interest to get her basis of $6,000. B, Kelly receives a 20% partnership interest as a gift from a friend. The friend's basis, without considering partnership liabilities, is $34,000. The fair market value at the time of the gift is $36,000. The partnership has liabilities of $100,000 when Kelly receives her interest. No gift tax was paid. Okay, here we treat gifts like we treat them just for individual income tax purposes. So like we did back when you took individual income tax, just as a reminder, anything I received as a gift, I took a transferred basis from the giver. I was able to adjust that basis up if the giver paid gift tax at the time of the gift. There's also this weird thing about a dual basis rule, where if the fair market value was less than the basis at the time of the gift, there would be a dual basis in the asset. We're not going to dive into that much complexity here. But here, Kelly is gifted an interest in a partnership. She's going to take a transferred basis of $34,000, and no gift tax was paid. So there's going to be no adjustment for that. So we start with a carryover basis, and then we add to that her share of partnership liabilities. Again, they told us the partnership has liabilities of $100,000, and she gets a 20% interest, so that's going to increase her basis. Her basis will be $54,000. C, Kelly inherits her 20% interest from her mother. Her mother's basis was $140,000. The fair market value of the interest is $120 on the date of death and $160 on the alternative valuation date. The executor chooses the date of death for valuing the estate. The partnership has no liabilities. Again, we're going to treat property inherited just like we did for individual income taxes. So the property she inherits is a partnership interest. And when we inherit things, we take a fair market value basis on the date of death or on the alternative valuation date, whichever the executor chooses. So here the executor chooses the date of death. So Kelly is going to take a fair market value basis in the estate. Her basis in that partnership is $120,000.